This week, the Strait of Hormuz, the most critical energy choke point on the planet, has nearly shut down. Brent crude is up over 8%, European natural gas has spiked 40%, and a fire is burning at Saudi Aramco's Ras Tanura refinery complex, one of the largest crude export hubs on Earth. And that's where we're starting today, and we're not stopping there. Welcome to Polaris Energy Finance Podcast. I'm your host, Terry Rimbold. And today's episode is one of those sessions where the macro just crashed through the front door. We've got a lot to cover, from the Strait of Hormuz and what it means for Asian central bank policy, to a fascinating story about how Meta's headline-grabbing AI buildout may be running on borrowed time and borrowed money, to a nuclear-powered cautionary tale from the UK that every infrastructure investor needs to hear, and two stories from the opposite ends of the grid stability debate, one about data centers nearly destabilizing the eastern US power grid, and another about Britain's push to be an AI data center powerhouse. Let's get into it. Over the weekend, US and Israeli forces launched strikes on Iran. Tehran retaliated hard. Iranian forces have effectively paralyzed commercial tanker traffic through the Strait of Hormuz. To put that in perspective, roughly 1/5 of the world's daily oil supply transits that waterway. It is the single most important oil choke point on the planet, period. The numbers coming out of the commodity data provider Kepler tells you everything you need to know. On a normal day, exports moving out of Persian Gulf monarchies through Hormuz run at roughly 22 million barrels per day. As of Sunday, that had collapsed to under 3 million. Over 700 non-Iranian tankers are currently anchored outside the strait, unable to move. Simultaneously, Iranian drones targeted Ras Rafah industrial city in Qatar, the backbone of the country's LNG export infrastructure. Qatar, for those who need the context, is one of the world's top LNG exporters. Qatari authorities intercepted the drones, but Doha halted LNG production as a precautionary measure. European TTF natural gas prices reflected that immediately, jumping roughly 40% intraday. On the crude side, Iranian's IRGC, the Islamic Revolutionary Guard Corps, has been warning commercial vessels they're banned from the strait. The Joint Maritime Information Center, which coordinates shipping guidance on behalf of the US and UK navies, confirmed Iranian ships actively warned vessels away. 4 oil tankers were struck Sunday alone. Now let's talk about what this means geopolitically, because Ras Tanura is not just any refinery. It handles over 6.5 million barrels a day in crude and products. It is Saudi Arabia's core crude export artery to Asia. When you talk about Saudi Arabia's swing producer capacity, so its ability to step in and stabilize global oil markets during a supply crisis, Ras Tanura is central to that capability. Crown Prince Mohammed bin Salman had reportedly drawn a hard red line at attacks on Saudi oil infrastructure. The Crown Prince has been executing a multi-trillion-dollar Vision 2030 economic diversification plan. An attack that materially undermines hydrocarbon export revenues doesn't just hurt the near-term budget, it essentially threatens the entire diversification thesis. Andreas Craig at King's College London framed it well, and I'm paraphrasing it here. When he said Iran is deliberately going after the Gulf states' economic centers of gravity, he argued Saudi Arabia needs to reestablish a credible deterrence posture, or the risk of further strikes goes up, not down. For investors positioning in energy equities or oil futures right now, the key variable is duration. If this is a brief, contained escalation, Brent spikes and retraces. If tanker traffic through Hormuz remains disrupted for weeks, the structural supply shock implications are very severe. Physical crude tightens, insurance premiums on tankers skyrocketing, backwardation steepening across the forward curve. Watch the shipping insurance market as a leading indicator. One more element that doesn't get enough attention here is cloud infrastructure. Amazon Web Services suffered a disruption to its UAE data center operations after unidentified projectiles hit the facility. The UAE has invested billions to build itself into a premier data center hub for AI workloads. An attack that targets that infrastructure, whether intentional or collateral, adds a new dimension to how we think about geopolitical risk for the digital economy. Let's zoom out to Asia. because that's where the inflation transmission mechanism is most acute. Asia is the marginal buyer of Middle Eastern crude. China, India, South Korea, those are the dominant destinations for the oil and LNG that moves through Hormuz. According to Moody's Analytics, Asia buys the lion's share of oil and gas produced in the region. And for advanced economies like Japan, Singapore, and Hong Kong, which import virtually all of their energy, a sustained supply shock is felt almost immediately in producer and consumer prices. Parallel being drawn in the market this morning is to 2022, when Russia's invasion of Ukraine sent commodity prices surging, inflation accelerated sharply across Asia, and central banks were forced into aggressive rate hiking cycles. The concern now is whether we're heading into a replay, but this time layered on top of an already complex backdrop of slowing growth, elevated household debt in some markets, and the ongoing uncertainty from U.S. tariff policy. OCBC's economists flagged it bluntly. Monetary easing bias will be put to the test. Central banks that were preparing to cut rates this year, and there were several across Southeast Asia, now face a dilemma. Do you stick with the easing trajectory and risk letting inflation get ahead of you, or do you hold, or even hike, and risk choking off already fragile domestic demand? On currencies, MUFG's Lloyd Chan flagged the Korean won, Indian rupee, Filipino peso, and Thai baht as particularly exposed. These are net oil importers with current account dynamics that deteriorate rapidly when energy import bills swell. Watch those exchange rates as a real-time gauge of market stress. Indonesia's central bank, Bank Indonesia, was already out Monday morning, confirming it would intervene in the foreign exchange market as needed. The Monetary Authority of Singapore, which as most of our listeners know, uses the Singapore dollar, NIR, as its primary monetary policy tool rather than interest rates, also confirmed it's in active assessment mode. The bottom line for macro-oriented energy investors here is that this is not a localized market event. The transmission channels from a Hormuz disruption into Asian monetary policy, into foreign exchange volatility, and eventually into demand destruction are well established. Duration of the conflict matters enormously, and the context here, as one Moody's economist noted, is a system that's been absorbing geopolitical shocks in series from COVID supply chains to Red Sea routing disruptions. Each one adds cumulative stress. All right, let's shift gears. We're moving from the physical energy market to the capital markets, and specifically to a story that should be on every energy investor's radar because it speaks to the financial architecture underpinning the AI buildout. Meta Platforms reported what looks on the surface like extraordinary free cash flow, $43.6 billion in 2025. On the face of it, that makes Meta look like a pristine money printing machine funding its AI data center expansion out of organic cash generation. The narrative is Meta is so profitable, it can self-fund the AI infrastructure arms race. Here's the problem. That narrative is at best incomplete, and at worst a bit misleading. The free cash flow is traditionally calculated operating cash flow minus capex, excludes certain cash costs that are very real but are classified as financing activities under GAAP. Specifically, the cash withholding taxes Meta pays when employees' stock awards vest, and the share repurchases Meta executes to offset equity dilution from those same awards. Let's run the numbers. Meta paid $18.4 billion in cash withholding taxes on vested shares last year. It spent an estimated $23.6 billion on buybacks specifically to neutralize stock award dilution. Together, that's $42 billion against $43.6 billion in reported cash flow. In other words, 96 cents out of every dollar of so-called free cash flow was consumed by employee compensation-related cash costs. Kevin Kowarki, an accounting professor at Purdue, put it simply, if you want a true valuation of the business, you have to reflect all operating costs as operating activities. The way traditional cash flow is calculated simply does not do that. The valuation implication is striking. At a reported free cash flow multiple of 38 times, Meta already looks richly priced. Adjust for the true cash costs of compensation, the multiple goes north of 1,000 times. And that's not a valuation metric, that's a warning signal. And there's more. Meta more than doubled its balance sheet debt last year to $58.7 billion. Why? Because the real cash generation wasn't sufficient to fund the AI infrastructure build-out. Additionally, there's a $27 billion data center project that was kept off balance sheet through financial engineering, the kind of structure that EY, Meta's auditor, apparently raised a red flag about. To be fair, Meta isn't unique here. Alphabet, Microsoft, and Nvidia all have significant stock-based compensation programs with similar cash dynamics. But at Meta, the ratio of compensation-related cash costs to reported free cash flow is dramatically higher than its peer group, so it's an outlier. What does this matter to energy finance listeners? Because the AI data center build-out is predicted on the assumption that hyperscalers like Meta have essentially unlimited capital to deploy into infrastructure. If that capital base is weaker than the reported numbers suggest, the pace of that build-out and the power demand assumptions embedded in grid operator forecasts may be overstated. This has direct implications for utility capex plans, long-term power purchase agreement pricing, and generation capacity investment thesis. Speaking of energy infrastructure build-out, if you want a masterclass in nuclear megaproject cost overruns, look no further than Hinkley Point C. This week, EDF, the French state-owned energy company developing the UK's first new nuclear plant in 3 decades, announced that the best-case startup date has been pushed back another year to 2030. The original target when the project was approved in 2016 was 2025, and the cost estimate has now ballooned to £49 billion in today's money, roughly $66 billion. The original 2016 estimate was £18 billion. In 10 years, the project cost has nearly tripled. To give you a benchmark, nuclear power plant expansion in Georgia, which itself became a symbol of Western nuclear cost dysfunction, running $16 billion over budget and 7 years late, is noted by the International Energy Agency as having cost less than Hinkley Point C, and that is a stunning data point. So what went wrong? The problem started almost immediately. In 2019, EDF disclosed challenging ground conditions and thousands of design changes required to meet UK regulatory standards. More steel, more concrete than planned. EDF's Chinese partner, China General Nuclear Power Group, stopped committing new capital in 2023 after the UK government bought out CGN's stake in the Sizewell C project on national security grounds. That left EDF needing to find replacement capital. Apollo Global Management agreed last year to provide up to £4.5 billion. EDF also took a charge of roughly £1.5 billion on the latest delay after writing off nearly £13 billion in 2024. Let that sink in. £13 billion written off in a single year on a project that was supposed to showcase European nuclear competitiveness. There's a cautionary tale here for the U.S. nuclear renaissance narrative. The administration has been bullish on nuclear. The same Westinghouse AP1000 design used at the Georgia plant is central to domestic nuclear ambitions. The UK's experience suggests that regulatory complexity, supply chain constraints, and first-of-a-kind construction risks remain formidable barriers to cost certainty in large-scale nuclear. The silver lining, if you're optimistic, is that the UK government has greenlit Sizewell C, structuring it with greater taxpayer risk-sharing to make the financing work. EDF claims construction efficiency has improved on the second Hinkley reactor. They're even sending engineers to China to study how the Chinese contractors managed to build reactors dramatically faster. The hope is that the learning translates to future projects. Small modular reactors remain a parallel track, theoretically lower capex, more standardized construction, faster builds. But commercial-scale SMR deployment is still years away. For infrastructure investors, the Hinkley lesson is clear. Nuclear is a long-duration asset with complex construction risk. The required rate of return to justify this risk profile is steep, and the financing structures for future projects will likely demand greater government backstops. Let's talk deal flow. This week, France's Engie announced it will acquire UK Power Networks, the electricity distribution network operator serving London and the southeast of England, from Li Ka-shing's CK Group in a transaction valued at £10.5 billion in equity, or about $14.2 billion. On an enterprise value basis, the deal prices UK Power Networks at approximately £15.8 billion, roughly 10 times estimated 2027 EBITDA. That's a solid infrastructure multiple, reflecting the regulated, predictable cash flow profile of a distribution network operator. Engie CEO Catherine McGregor called it a deal that would both enhance the group's growth trajectory and reduce risk profile. On the CK Group side, this is an interesting portfolio rotation. CK Infrastructure, Power Assets, and CK Asset are collectively booking substantial gains. CK Infrastructure alone expects a gain of over 14 billion Hong Kong dollars. Share of all 4 Hong Kong-listed entities in the group moved higher on the news. This is a disciplined capital allocation from a Hong Kong conglomerate that has been systematically monetizing Western infrastructure assets at premium valuations. For Engie, UK Power Network becomes the cornerstone of its UK strategy. The financing structure is worth noting. Roughly 5 billion euros of debt and hybrid securities, plus an asset disposal program of about 4 billion euros through 2028, and up to 3 billion euros in an accelerated book-building equity raise. They're clearly managing leverage carefully to protect their investment credit rating, which for a regulated infrastructure operator is non-negotiable. Thematically, this deal speaks to a broader pattern. European utilities are actively building regulated infrastructure positions in markets with clear long-term grid investment pipelines. UK Power Networks is not just a passive distribution asset. It's sitting at the intersection of the EV charging build-out, the AI data center connectivity wave, and the renewable integration challenge. Whoever owns the wires in Southeast England owns the toll road for the energy transition. Here's a story that hasn't gotten nearly enough attention in the investment community, but it should. The conventional risk narrative around data center goes like this. Data centers consume an enormous and growing share of electricity, potentially up to 17% of U.S. power demand by 2030, according to new projections from the Electric Power Research Institute. That demand load strains supply, especially during peak demand periods, and creates reliability risk. What's emerging is the mirror image risk. What happens when 40 or 70 data centers simultaneously disconnect from the grid? That actually happened twice. In July 2024, approximately 70 data centers in Virginia switched to backup power generators when a high voltage line failed, creating a sudden demand cliff on the PJM interconnection grid. In February 2025, it happened again. Roughly 40 data centers dropped off the grid simultaneously. In each case, the demand loss totaled under 2,000 megawatts. Significant, but manageable. PJM's operations team responded quickly enough to avoid a crisis. The concern PJM has laid out explicitly is, what happens when the number gets bigger? Mike Bryson, PJM's senior VP of operations, said directly, what if that happens for 3,000 or 5,000 megawatts? At that scale, the rapid supply-demand imbalance could damage power plant equipment or trigger cascading outages. The physics are straightforward but important. Grid stability requires continuous, real-time balance between electricity supply and demand. An excess of supply, not just a deficit, can cause generators to overspeed and fail. Data centers are designed to protect their own operations by switching to backup power at the first sign of grid disturbance. But that self-protective behavior, multiplied across hundreds of facilities, creates a dangerous demand cliff. Dominion Energy, which serves Virginia's data center alley, has been working with tech tenants on ways to keep facilities grid connected during brief fault events rather than defaulting to backup immediately. NERC, the North American Electric Reliability Corporation, hosted a conference in February specifically to address this, with Google, QTS, and other major data center operators participating. NERC's chief engineer, Mark Lobby, called it one of the most important emerging risks they're tracking. For investors and utilities, This creates a new layer of complexity in earnings visibility picture. The capital expenditure required to harden grid infrastructure for high-density, large-load customers like data centers is substantial, but so is the potential regulatory scrutiny and the liability if these events escalate into actual grid failures. All right, let's talk about the ongoing legal deconstruction of the ESG investment framework, because last week brought a significant development. Vanguard has agreed to pay $29.5 million to settle litigation brought by Texas and a coalition of Republican-led states. The lawsuit accused Vanguard, BlackRock, and State Street of coordinating to use their influence as the three largest passive fund managers to suppress coal production through proxy votes, engagement campaigns, and participation in industry groups like Net Zero Asset Managers. Vanguard did not admit wrongdoing. The settlement language from Vanguard was carefully calibrated. They said it reaffirms their long-standing practices and the passive nature of their index funds. The translation: we want this off our plate. Reports indicate the firm weighed tens of millions in potential legal fees against the settlement cost and chose to exit the litigation. BlackRock and State Street declined to settle, and the case continues. State Street has been direct. They call the lawsuit baseless. BlackRock has declined to comment publicly. The stakes here extend far beyond coal. A judge in August denied the defendant's motion to dismiss, allowing the case to proceed. If Texas and other states ultimately prevail, the president would fundamentally reshape how passive index funds engage with portfolio companies on environmental and governance matters. Proxy voting, engagement policies, and membership in climate finance initiatives, all of it potentially exposed to antitrust-style liability. Texas AG Ken Paxton characterized the settlement as setting a new standard for institutional investors. That's aggressive framing, but it's the political reality. All three asset managers had previously scaled back their involvement in high-profile climate finance coalitions amid Republican political pressure. The broader Wall Street retreat from explicit ESG commitments has been underway for the better part of 2 years. For energy sector investors, this is material. Activist engagement from large passive funds had been one of the structural tailwinds constraining upstream oil and gas capex and accelerating capital allocation towards renewables and energy transition. If that engagement channel becomes legally risky, the investment industry's ability to influence corporate capital allocation decisions on decarbonization weakens substantially. Let's move quickly through three more stories worth tracking. First, Johnson Matthey and Honeywell. Johnson Matthey, the British platinum refiner, cut the sale price on its Catalyst Technologies division being sold to Honeywell by more than a quarter. The division, which makes catalysts for the chemicals and energy industries, is now priced at £1.325 billion, down from the initially agreed level. The reason is that weaker than expected performance in fiscal 2026 as sustainable solutions licensing projects were deferred and market conditions pressured catalyst supply margins. Johnson Matthey still plans to return around £1 billion to shareholders through an £100 million special dividend and a £200 million buyback, but the deal extension, in which deadline pushed to July 21st, possibly August, signals ongoing execution risk. The key takeaway here is that the energy transition catalyst market is softer than anticipated. Second, the UK's first commercial lithium plant. Geothermal Engineering has opened the UK's first commercial-scale lithium extraction facility in Redruth, Cornwall, initially targeting 100 tons per year, with ambitions to scale to 18,000 tons annually over the next decade, requiring £640 million of investment. The project is powered by the UK's first geothermal power plant, with excess power flowing to Octopus Energy. The geopolitical backdrop matters here. China controls roughly 60% of global lithium processing, and Beijing's move last year to restrict critical minerals exports injected fresh urgency into Western supply chain diversification. Analysts are cautiously constructive. The raw material cost for lithium is a small portion of an EV's total bill of materials, so premium pricing for domestically sourced lithium is theoretically absorbable. The bigger bottleneck is the downstream cathode active material manufacturing capacity, most of which remains in Asia. That's the missing link in the Western battery supply chain. Third, Italy's power market decarbonization reform. Italy is proposing something genuinely novel in European power market design. The core problem, EU carbon pricing on gas-fired power plants sets wholesale electricity prices for all generators, including renewables. Because gas plants are the marginal producers most of the time, in the UK, for example, gas sets the power price 85% of the time despite producing just over a quarter of generation. Italy's proposal, reimburse gas generators for their carbon permit costs directly and recover that cost explicitly on consumer bills. So consumers are only paying the carbon tax on the share of power actually generated by gas, not on the entire system. The estimated consumer benefit is around 10 euros per megawatt hour. It's an interesting and politically courageous proposal. Climate and competition regulators in Brussels will scrutinize it intensely, and it's unlikely to pass unmodified. But the debate it surfaces about who pays for carbon transition and how the marginal pricing mechanisms distribute those costs is one every European energy investor needs to follow closely. Let me tie a thread through today's episode, because I think there's a unifying theme that doesn't always get stated explicitly. Everything we covered today is fundamentally about the tension between the energy system we need to build for AI, for electrification, for decarbonization, and the capital, the physical infrastructure, and the stability required to build it. The AI build-out is real. The power demand it creates is real. But as we saw today, Meta's balance sheet is not as clean as it looks. The grid reliability risks from large load volatility are not theoretical. They've already happened. The nuclear capacity needed for the around-the-clock clean power is decades away from meaningful scale. And the most expensive nuclear plant in history is still not operational. And the Strait of Hormuz, a waterway that today handles a fifth of the world's oil, can be shut down by a determined state actor with drones. Meanwhile, the regulatory and legal framework governing how capital can influence the energy transition is being contested in courtrooms in Texas, in Brussels, and in Westminster. These are not separate stories. These are the facets of the same complex, high-stakes capital allocation challenge that defines energy finance in this decade. As always, thanks for spending part of your day with us at Polaris Energy Finance. If this episode was useful to you, share it with someone who needs to understand the intersection of energy and capital markets right now.